Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Phillips 66 Partners stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Phillips 66 Partners is a master limited partnership formed by Phillips 66. It owns, operates, develops, and acquires crude oil, refined petroleum products, and natural gas liquid pipelines, terminals, and other midstream assets. Let's get started with the model. This is a mid-cap company, 6.3 billion market cap. They're trading at $28 a share, and they have 228 million shares outstanding. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Examples are cost of labor and cost of materials. The difference is their gross profit. That peaked in 2019 at $1 billion. Below that is operating expenses. Examples are depreciation and insurance. Then below that is operating income. The trailing 12-month number is pretty close to the peak in 2019. Then below that is the interest they pay in their debt. That's about $100 million a year. Then below that is other income and expenses. That was positive $600 million in the trailing 12 months. This is from its earnings and equity interest. That's its earnings in other companies. Then below that is pre-tax income, and they don't pay much taxes since they're a master limited partnership. The bottom line of the income statement is their net income, and that peaked in the trailing 12 months. The reason it was higher than 2019 was their other income and expenses were so high in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. When the company invests in a new pipeline, that cost goes into CapEx. And operating cash flow minus CapEx gives you your free cash flow. Free cash flow is the cash that's remaining to pay a dividend or to buy back stock or pay down debt. So they don't have too much free cash flow remaining. It looks like they're issuing a lot of capital stock, $1.2 billion in 2017, then $100 million, $170 million, and $130 million. When a company issues capital stock, it increases the shares outstanding, making your shares less valuable. They added a lot of debt in 2019. They added about $500 million of debt that year because they issued $1.8 billion and they paid down $1.3 billion. They also added $400 million of debt in the trailing 12 months. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. This company does generate a lot of operating cash flow, up to $1 billion a year. And you could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. The way you calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. The company passed through a $123 million depreciation expense. That brings down their net income, but it doesn't affect cash flow. It looks like they passed through $79 million of non-cash gains. So we have to minus that out on the CFO section. The company reported a little under $1 billion of profit, but they generated a little more than $1 billion of operating cash flow. Let's look at the capital structure. $2.9 billion of equity, $3.8 billion of debt. They have 43% equity, 57% debt. And their WACC is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $9.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.2 billion. We divide that by 228 million shares. And we get a calculated stock price of $36. They're trading at $28, so they're trading at a 23% discount. It's a buy according to the model. Simply Wall Street is pretty close to me. They're at $34 a share. They're also saying the stock is undervalued. The reason the future free cash flows are so much higher than the past free cash flows is based off of analyst estimates. And it's also based off of how much the company's investing in their business to grow it into the future. So it seems like their free cash flows will be much greater in the future than they've been in the past. This is the stock price the last 5 years, and it was pretty steady for about 4 or so years, and it peaked about $60, but it's at a really low point, under $30, so it's trading at 50% of its all-time high. And this company pays a big dividend, over 12%. It pays out 82% of its net income, and they do seem to be raising their dividend each year. They doubled it from 2016 to 2020. They have a beta of 1.12, so the stock moves a little more than the market. The stock has gone down 54% in the past 52 weeks, compared to the S&P 500, which went up 17% in the same time frame. The 52-week low is 19, the high is 60, and the stock is trading above its 50-day and 200-day moving average. About 1 million shares are traded each day on this stock, and of the 228 million shares outstanding, 58 million are on float, 22% are held by institutions, and 4% of the shares on float are shorted. If you invested $10,000 into this company in 2013 when it IPO'd and reinvested the dividends, you'd have $13,000 today. The parent company owns 74% of their stock. That's why they have such a low float. The next biggest shareholder is Alps at 4%, then Tortoise, then First Reserve, and last is JP Morgan. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 6.5, so investors are paying $6.50 for $1 of earnings. That's a really good PE ratio. Price to sales is stock price over sales per share. They're at 5.9, which is between the median and average. Price to book is stock price over book value per share. They're at 2.2, which is better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $2.9 billion of equity, $2.7 billion of tangible equity, since they have $185 million of goodwill on that balance sheet. The way a company gets goodwill on its balance sheet is when it acquires a company for greater than its net assets. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 4.4 times. ROE is net income over equity. They have a great ROE at 34%. Current ratio is current assets over current liabilities. They can only cover 20% of their current liabilities with their current assets. Their current assets are $2 million of cash, $88 million of receivables, and $14 million of inventory. The company appears to be undercapitalized. They only had $87 million of free cash flow. They have negative $400 million of working capital, and they have an $800 million dividend payment. So they're short $1.2 billion. They're probably going to need to take on more debt or sell more stock to run their business over the next 12 months. But as you can see, they have a really high ROE, so they are a profitable company. They're investing so much in their business, they have low free cash flows, but I think in a few years, the cash will start rolling in. The best way to look at ratios to compare them to similar companies, I've done videos of 45 midstream companies, and the average is right here. Phillips has an average PE ratio. They're doing worse than average in price to sales and price to book. They're doing much worse in current ratio. They have a great ROE. They're a little lower in debt. They're a bit lower in market cap, and they do pay a higher dividend than the average. So to summarize, I have them trading at a 23% discount. This company, I think, is going to start growing a lot in the future, and I think it's a lot less risky, the fact that they're part of a bigger, massive company, which is Phillips 66. And they pay a great dividend, so if you're looking for a nice dividend, they're paying almost 13%, and they don't seem to be cutting their dividend anytime soon. I ranked their free cash flows 3 out of 10. They were negative in 2019 and pretty small in the trailing 12 months. I ranked their revenue 7 out of 10. It did drop in the trailing 12 months, but not by too much. And I ranked their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.